And then you add $10 of debt and you get 10 cents. It's like there's diminishing returns on debt because, of course, debt does have interest. And it also skews the values of the people who are getting this kind of nearly free money. In other words, if you can borrow a lot of money at like 1 or 2%, and you can earn a return of 3 or 4%, then you go, wow, let's just borrow more money because it makes sense, right? And I think that's been driving a lot of the real estate market when interest rates fell because of the Fed stimulus and its policies. Then people that had assets and were already wealthy, then they looked at this as an opportunity, right? Like I can go borrow money really cheaply and go buy a couple of units or a couple of single family dwellings and rent them out. And then when Airbnb came on board and people started to hear from their friends about the huge amounts of profit that you could earn if you could fill an Airbnb unit in a desirable, tourist area, then a lot of people rushed into that. So this would not have been possible without like abundant, cheap credit. And I think that's what we're talking about. If mortgage rates, and you and I are in the same generation, so we remember when a standard mortgage was 7% or 8%, or in fact, it was as high as 10 or 12 or even 18% back in the early 80s. But we didn't think that a 10% mortgage was unbelievably high, and 7 or 8 was like kind of normal, And so to have a mortgage at 3.25% or something, that's just unprecedented. And so it unleashed a wave of credit expansion, but not just across the board. That's what maybe the Fed intended. We can guess or hope that the idea was